I know that as you transition into retirement, it's really important to focus on income so that you can pursue your goals. However, when we step up to some of the bigger conversations, those tend to lead to some sleepless nights as well. And I want to share with you some of those conversations we have with our clients in this video. But before we do that, make sure that you subscribe to our channel and hit the notifications bell so you're alerted to when we post new videos. I've mentioned in previous videos, based on our new book, Don't Outlive Your Money in Retirement, that there's 7 steps that you need to take. And leading up to this moment, we've really set up for your retirement in terms of understanding your cash flow needs, where it's going to come from, what kind of management of your money should you be thinking about? How do you reduce your taxes? How do you maximize your Social Security? And overall, put in place an income plan that will help you and your spouse, if you're married, pursue your retirement goals, making sure you have enough liquidity, money, to do that. Once you've finally, in the planning process, put all that together, we then go to some of the 30,000-foot questions that do tend to provide for some sleepless nights as we think about them in the big picture. So let's start with how I define the 3 stages of planning now that we're retired. The first is when the two of us are together, we're enjoying the journey. As I've said, you've worked hard for this retirement. I want you to enjoy it fully. And then at some point, maybe we start to get a little older and one of us has passed away. So we have to make sure that we provide for the surviving spouse in that second stage of planning. And then eventually he or she will then pass, and we have to make sure that we've put in place the planning to make sure the rest of the planning and the family is taken care of. We call that legacy planning. So let's dive into this so that maybe I can help relieve some of the sleepless nights that you may be sensing as you are transitioning into this next chapter of life. So as I meet prospective clients, the conversation starts a lot with the concept of money management. Am I taking on too much or too little risk? How do I get, the cash flow to pursue my goals? But one of the biggest overriding questions that they have for me once we finally delve into it is, how do I take care of my surviving spouse? And one of the items from a planning perspective that we may have to deal with for some who've worked in the corporate world, and you have pension choices, pension options, which one is best for you so that you can get the cash flow you need now and for the next few years, and also when you pass, that your spouse is taken care of. So I want to share with you a conversation that we call the pension maximization conversation, and give you a sense of how to think about this. Not so much the numbers per se, because that can get confusing. But I want to keep this in such a way that we can keep it as simple as possible so that you walk away understanding how to think about this. Now, typically, if you do have a pension available to you, you may have, let's call it 3 different options. Option A, you take 100% of the pension available to you, leaving your spouse, when you pass, nothing. And actually, the government has said that if you do take that option A, if you will, that you must sign off, that you recognize that that's what will happen. Okay? Option B, we take some reduced number from the 100% so that we can provide our spouse when we pass, let's call it 50% of our maximum pension. And option C could be we take a further reduction in order to provide 2/3 of the pension available to the surviving spouse. You get the idea. You can take the maximum, but then there's no available income for the surviving spouse, or you can lower at some level your current cash flow from the pension in order to, in essence, buy insurance that your spouse will get some guaranteed level of income when he or she is surviving you. Now, the answer to whether I should take A, B, or C is not clear cut. Oftentimes, when you talk to HR, if they're even able to give you any guidance, they tend to typically say, don't take A because he or she, the surviving spouse, won't, have anything left. You should probably take B or C. But it all depends on your circumstances. How much income do you need? How much in the way of assets do you have so that you can generate the income that you need? So there is an option D, which they typically don't guide you because they're not supposed to. They can't take on the liability of giving you guidance or counseling. They can just basically tell you what A, B, and C are. But we often introduce the concept of option D, which is the pension maximization option. And this is what the pension maximization solves for, okay? With option A, you maximize your cash flow, but your surviving spouse, let's call it my wife, she won't get anything when I pass. Now, if I take option B or C and I agree to take a lower level of pension, typically, even if my wife predeceases me, I'm stuck for the rest of my life with the lower pension amount. Typically, unless you're sometimes a teacher or in a municipality, you don't have the step back up to A, okay? So I'm stuck with that lower amount. So, we don't know. We don't have a crystal ball. Well, if the numbers allow, and it makes sense, then the pension maximization option could be the best choice. And what the pension max is in essence, marrying up, taking option A and buying a life insurance policy that would be owned within an irrevocable life insurance trust. Now, the numbers don't work for everybody, but where it does, it's kind of nice. Because what it says, basically, if we do the pension max, is if I pass first and I've taken A, traditionally under A, she would get nothing. But because instead of taking nothing, we've replaced that with an insurance policy that will generate the income that she needs, then she's going to be all set when I go. But when I'm around and we're both around, we've maximized that pension number. Now, on the flip side, if she predeceases me, I don't want to get stuck with some lower pension amount. So what I would do is potentially stop funding the irrevocable life insurance trust. And in that way, I would get that cash flow back that I was funding for the life insurance. And basically, in essence, I would have taken B or C, and because I get the cash flow back, bump myself up to the equivalent of the maximum pension. So the big takeaway here is you have to understand there is another option to consider, again, not for everybody, but where the numbers do work. They do solve for the holes or the deficiencies in the traditional pension offerings. The next conversation we have deals with the topic of life insurance. Now, historically, when we were younger, we needed life insurance, particularly if we had kids. Wanted to make sure if that we weren't here, that the surviving spouse and the kids could pursue their goals, our dreams for them. And that was the purpose for life insurance. And hopefully, if you're watching, you didn't have to use that, right? So the question is now that you go into retirement, do you need life insurance? And from my perspective and my conversations with my clients, I tell them there's really only two reasons to, at this stage of your life, own life insurance. One, if you do have some form of pension, we just talked about that, and when you die, the pension goes with you, leaving your spouse with not enough income, then it might be appropriate to own the life insurance and then own it in an irrevocable life insurance trust. The other reason to own life insurance is if your estate is large enough that either at the state level or at the federal level, there will be death taxes associated with your passing, and you wish to, one of your objectives is, from an estate planning perspective, pass as much of the 100% or whole of your net worth to your heirs. If you don't care that the government is going to take some amount of money for death taxes, and that you're okay with that and leaving the balance to your heirs, then life insurance then is not necessary. But if your objective is, listen, I've accumulated this amount and I really want to pass along as much of that as I can, then maybe buying a life insurance policy, and here again, owning it in an irrevocable life insurance trust. And the reason why you own it in what we call the ILIT, the ILIT, is that it's owned outside of the estate and you don't pay taxes on it. Okay? So again, the only two reasons I believe to own life insurance is if there is a pension situation and you're going to lose it, or if you have an estate tax situation where it doesn't sync up with your objectives and you want to pass as much as you would like to your kids. In line with the life insurance conversation, we have the long-term care insurance conversation with every single client. And that doesn't mean that every single client then moves forward to then purchase long-term care insurance, but it's important to understand what it is. For the most part, we all have this sense of, at some point down the road, we don't want to become a burden to fill in the blank. Okay, the rest of the family, the kids, whomever. So that's where insurance comes into play. However, we are hesitant to pay for this insurance because it's, to be honest with you, it's not inexpensive, particularly if you've waited until your 60s or 70s to purchase it. So first of all, we have the conversation as a part of the overall estate conversation. Now, I don't do estate planning, but we are looking to preserve and protect the assets, and a part of that conversation is long-term care insurance. And we talk about, whether or not, because most of my clients have had someone in their family or close to who have dealt with a situation where preservation of assets during this time of life has been an issue. It could be very costly without long-term care insurance, $100,000, $150,000 a year, depending upon where you are and what the need for care is. So the way that we think about funding for the long-term care insurance, if they want to pursue it, is in a number of different ways. First, we just talked about life insurance, and if it's no longer needed, and if they had been paying for the life insurance, it may be more prudent to use the money that was funding the life insurance to fund the long-term care insurance. And the other way that we look at, particularly for those who are taking required minimum distributions, and for those, and most of my clients are this way, they don't necessarily need the cash from the required minimum distribution. Their cash flow is all set. But if they are taking it from the required minimum distribution, because we have to, earmarking some of that money that has to come out anyway, and that we really weren't sure what the use of that money was going to be, potentially earmarking it to pay for the long-term care insurance. So I think having the conversation is important, understanding the cost of it, both not having it and paying for the premium, And then if you decide to move forward with it, figuring out where the money should be coming from so it doesn't impact your daily cash flow and your pursuit of your retirement dreams. Now, the final item that is brought up under this estate planning type of bigger picture conversation is the area of gifting. Many of us have grandkids that we want to gift to their future education, or the kids need some help, or we went to an institution and we want to help that college or university. And my initial comment to my clients is this: you are my client. And if you wish to give some $50,000 or $100,000 to a 529 plan, or gifted, to pay for, college, or pay to the college for their purposes as a donation, you need to make sure, first and foremost, that by gifting this money, it does not today or tomorrow impact your ability to pursue your goals. And that's where the planning comes into play, because we can literally put in place in the plan, if I do want to spend X amount of money in a certain amount of years, what will be the impact on my ability to continue to pursue my goals? So overall, from a legacy planning perspective, from a bigger picture planning perspective, it's important to identify those items that could keep you up at night as you think about properly setting up and aligning for how the two of you are going to be taken care of now, how my surviving spouse, how she may be taken care of later, and how to make sure that the legacy planning is put into place. And that takes into account coordination of not just the financial planning, but the tax accountant as well, and the estate planning attorney, and getting the advice from all of those, sometimes together as your dream team, could get you to where you want to be. If you have more interest in learning more about the 7 steps, make sure that you watch our playlist. And I truly do hope that you enjoy the retirement journey.